The team at Technology for Hotels knows how busy you are, so we've created this concise briefing to keep you up to date on key happenings in the hotel industry. Let's dive in.
Welcome to the 5-Star Weekly Briefing, your pulse on the hospitality industry.
This week's briefing is brought to you by Saba Hospitality, digitizing the guest journey with award-winning mobile ordering and engagement tools that drive revenue without the need for app downloads.
Today, Friday, 8 May 2026, and I have to point out we are hitting a pretty massive milestone today.
Oh, yeah, we are.
Yeah, this is edition 75 of our briefing, which is, pretty exciting.
75, yeah, it's a big one. And it feels fitting because, looking at what crossed the desk this week, the sheer velocity of change in our industry right now is just staggering.
It really is. I mean, we've been tracking these structural shifts for a while, but some of this stuff feels like it's straight out of science fiction.
Exactly. So picture this. It's 2028, right?
Okay, I'm picturing it.
A high net worth corporate client lands at Sydney Kingsford Smith.
Yeah.
Now, instead of sitting in the back of a town car, fighting like an hour of M4 gridlock to get to Parramatta.
The absolute worst drive.
Right. Instead of doing that, they step into an electric passenger air taxi and drop directly onto the roof of your hotel.
Wow. Just right on the roof?
Right on the roof. And the crazy thing is that isn't just some white paper concept anymore. ValueSuites Group has actually commenced construction on a 182-room flagship in Parramatta.
Wait, so this is actually happening?
It is. It's designed and built from the ground up with purpose-built drone landing facilities.
That is wild.
Yeah, Ashish Shakya and the team there are making a really fascinating CapEx play. When you look at their existing portfolio, across Penrith and Green Square, Surrey Hills, they heavily target that corporate and government sector.
Right, which makes sense for Parramatta.
Exactly.
Yeah.
So from an asset management perspective, building the structural reinforcement, the acoustic dampening, the regulatory fire safety frameworks into the concrete today is really the only way this works.
Because retrofitting it later would just be impossible.
Yeah, trying to retrofit a live hotel roof for heavy payload air mobility in 5 years,
yeah,
that would be a total financial nightmare.
I mean, I hear the future-proofing argument, I do, but let's play devil's advocate for a second here.
Okay, go for it.
You are pouring millions of dollars into rooftop load-bearing infrastructure, right, for an aviation sector that is still, frankly, heavily bottlenecked by municipal airspace regulations.
Sure, the regulations are a hurdle.
Right, so if commercial air taxis get delayed by a decade, you've basically just built the world's most expensive empty concrete slab instead of, say, a revenue-generating rooftop bar.
Well, I actually view the risk profile a bit differently. I kind of liken this to the groups who wired their properties with heavy fiber optic infrastructure back in the late 90s.
Okay, yeah, that's an interesting comparison.
Right. Because at the time, critics said guests barely used dial-up. But when broadband became the baseline corporate expectation overnight, the properties that didn't have that infrastructure built into their walls, they lost their premium corporate contracts almost instantly.
That's a really good point.
By building the landing pad into the DNA of the property now, Ashish is essentially buying a 20-year relevance insurance policy for corporate travel.
It certainly redefines the arrival experience, doesn't it? Like, we've spent a century optimizing the ground floor grand lobby, and suddenly your VIP front door is literally on the roof.
Completely flips it on its head.
It really does. But, contrast that futuristic, super high-risk capital play with what is happening just up the coast.
Oh, up on the Sunshine Coast?
Yeah, we are seeing aggressive regional expansion there, but the risk mitigation strategy is entirely different. Construction has just kicked off on the $150 million Crowne Plaza Maroochydore.
Which is huge, because that corridor has been starved for premium branded inventory for a while now.
Oh, absolutely. It's going to be a 13-story mixed-use development, so 180 guest rooms, plus 24 luxury AER residences.
That's a massive injection of premium stock.
It is. But what fascinates me here isn't just the scale of it. It's the mechanics of how Felix Capital's director, Michael Marone, and IHG's Matthew Tripolone actually got this out of the ground so fast.
Right, because getting projects moving right now is not easy.
Exactly. They utilized the local council's hotel investment incentive scheme to fast-track the entire project. So they didn't rely on future tech to secure the asset's value. They utilized a direct government partnership.
Which is just smart municipal strategy. Local councils are finally doing the math, I think. They realize that securing a powerful global distribution engine like IHG's isn't just about, bed tax.
Right, it's bigger than that.
Yeah, it drives high-yield institutional tourism into the local economy. Incentivizing developers to build premium inventory just makes sense.
It really does. And if we look across the ditch to New Zealand, we are seeing operators achieve that premium brand standard without actually digging a single hole in the ground.
Ah, you're looking at the Mercure Tauranga launch.
Precisely. It's the city's first internationally branded hotel.
That's a great project. Antoinette Mala-Haroni at Prime Hotels partnered with Accor's Pacific COO, Adrian Williams, to refurbish the old Hotel Armitage, right?
Yeah, and this is actually Prime's third New Zealand property under Accor management. But the operational nuance that stands out to me here isn't the multi-million-dollar hardware upgrade.
What is it then?
It's the human capital strategy.
Yeah.
They actively retained the existing workforce through the entire transition.
Oh, wow. Yeah, that is surprisingly rare in a major rebrand.
Usually, right. Usually a new flag means a total sweep of the management and frontline teams to enforce the new corporate culture.
Which, let's be honest, often destroys the local soul of the property.
Exactly.
When you are operating a mid-scale asset in a regional city like Tauranga, your regular corporate clients book because the front desk manager knows their name. They know their preferred room.
Right, they want that familiar face.
Yeah, so upgrading the hardware to Mercure standards while keeping the institutional knowledge of that local workforce. That is just a brilliant way to protect your baseline revenue during a transition.
It really is. And that pivot from building new to converting existing assets, it points to this massive structural reality dominating the corporate side of our industry right now.
The conversion trend.
Yeah, we saw the Q1 results from the major global players this week, and the push for capital-efficient, conversion-led growth is just incredibly aggressive.
It's everywhere.
Let's look at Choice Hotels International. Under CDO Patrick Pacious, they hit first quarter revenues of $340.6 million.
That's a solid quarter.
It is. Their adjusted EBITDA dipped slightly to $125.7 million due to timing, but the statistic that should make every independent owner listening to this sit up is their 72% surge in global franchise agreements.
72%. That is a massive jump.
Right.
But it makes perfect sense when you think about it. Their international portfolio grew by 13% because the sheer cost of debt is practically forcing the hand of independent operators right now.
Oh, completely.
If you own an unbranded boutique property right now, your operating costs are soaring, and fighting the OTAs for visibility is just bleeding your margins dry.
It's exhausting.
So plugging into Choice's distribution engine, specifically through their Radisson Individuals or Ascend collection, it's not just a strategy anymore. It is simply a survival mechanism.
Yeah, and Wyndham Hotels and Resorts is executing the exact same playbook. CEO Jeff Bellotti announced a record 259,000-room development pipeline.
Wow.
Yeah. Global RevPAR saw a 1% dip, but look at the APAC region, they hit a 12% growth rate.
12% in this climate is huge.
It is, and we are seeing the ground truth of that APAC growth play out in real time with the Ovolo Group. Siobhan Junwala just partnered with Wyndham's VP of Business Development, Matt Holmes, to launch the Bennett by Ovolo Perth.
Set to open in 2028, right?
Yep, 111 rooms.
That is the perfect case study. Because Ovolo is fiercely protective of its disruptive boutique identity. 10 years ago, an operator like Ovolo would never align with a massive machine like Wyndham.
Ever.
But today, the conversion models are sophisticated enough that Ovolo can actually keep its unique brand culture while tapping into a massive global loyalty program.
Exactly. Accor is pulling the exact same levers over in South Australia, too.
Oh, really?
Yeah, property owner Mattioli Group is dishing the Peppers flag on their Weymouth Adelaide property. They're doing a multi-million-dollar refurb and converting it to the Mövenpick Hotel Adelaide by the end of 2026.
See, fast execution, immediate distribution uplift, zero groundwork required. That's the conversion magic.
Precisely.
However, while the mid-scale and upper mid-scale sectors are, absolutely obsessed with conversions to navigate these construction costs, the luxury and lifestyle segments are playing an entirely different game.
Totally different.
They are forcing massive, complex, ground-up developments into the market at a breakneck pace.
Yeah, the pipeline numbers are just staggering. Hilton's president for the region, Alan Watts, is driving a push for over 250 luxury and lifestyle properties across APAC.
250.
Yeah. Nomad is making its market entry in Singapore. Signia is launching in Tainan. Waldorf Astoria and Conrad are aggressively expanding into Malaysia.
It's a huge footprint.
And locally, we've got the Motto by Hilton Sydney City Centre and the transformation of the Palazzo Versace on the Gold Coast into an LXR property.
Right. But the sheer scale of that pipeline exposes a really foundational shift in how these properties are actually run.
How so?
Well, because when Hilton signs 250 new properties, Hilton isn't necessarily hiring the GMs, managing the payroll, or running the day-to-day operations.
Right, this is where the traditional franchise model really starts to fracture. You used to have the owner who provided the real estate and the brand who provided the management.
Exactly. But now it's a triad. You have the owner, the brand, and then the independent white label operator. Take the newly signed Hilton Adelaide East End. It's a 251-room new build flagship slated for 2031.
Beautiful project.
Auriga Investment Group is the developer supplying the capital. Hilton is supplying the flag, the standards, the booking engine. But the actual boots on the ground, the day-to-day management, is being handled entirely by Trilogy Hotels.
Interesting. But put yourself in the shoes of an institutional owner for a second.
Okay.
Why would you willingly dilute your NOI by paying a franchise fee to Hilton and a management fee to Trilogy? Doesn't adding a middleman just eat your profit?
On a spreadsheet, it definitely looks like double dipping, but operationally, it actually increases your yield.
Really?
Yeah. Think of global brands as incredible software. They drive loyalty members to your booking page, but they're often slow, bureaucratic operators. A white label operator like Trilogy acts as a hyper-focused, localized asset manager.
Ah, I see.
They're agile enough to strip out operational bloat that a massive corporate brand might just ignore. And Trilogy isn't exclusive to Hilton. They are also managing the new Courtyard by Marriott Sydney Crow's Nest for developer DieCorp.
Right, so they really are just independent operators. And it's not just an East Coast phenomenon either. APPL Group is launching the 120-key Radisson Perth later this year, and they've tapped Mandala Hotels and Resorts as their independent white label operator.
See, it really does seem like the triad structure is the new baseline for institutional capital.
It is. But, all of this institutional capital pouring into luxury new builds assumes that the consumer actually has the discretionary income to fill those rooms.
That is the big assumption.
Right. And if we look at the data coming out this week, the consumer market is deeply fractured. We are basically operating in a brutal K-shaped hospitality economy right now.
We really are. Let's define the top arm of that K first, because if you are servicing high net worth international guests, your revenue is practically operating in a different dimension.
Oh, completely. The Queenstown Lakes District just posted NZ $2.83 billion in visitor spending for the year.
Billion with a B.
With a B. And a massive NZ $1.79 billion of that is pure international inbound capital.
And institutional money ruthlessly follows that data. Accor News and Road Genius broke down how this financial health is driving aggressive repositioning in that market.
What kind of repositioning?
Well, Pro Invest Group and IHG are pushing their assets upmarket into the premium Voco Queenstown later this year, and Marriott just signed a St. Regis for the city for 2027. The ultra-luxury fly-in market is completely insulated.
It's bulletproof, but then you drop down to the bottom arm of the K, and the reality is pretty sobering.
It's rough.
If you look at the data presented at the AHICE Asia Pacific Conference in Adelaide by Accommodation Australia's James Goodwin and David Mansfield, alongside CoStar STR, the domestic market is just suffocating.
Yeah, the dual pressures of geopolitical uncertainty in the Middle East and punishingly high fuel costs have completely crippled consumer confidence.
It really has.
If you were a GM at a regional property relying on domestic drive tourism, you are looking at an empty booking sheet right now, because the average family literally cannot justify the cost of petrol to drive 3 hours up the coast for a weekend.
It's just too expensive. Accommodation Australia is lobbying hard alongside the Tourism and Transport Forum for government promotional support.
Which is needed.
Yeah. But if you were managing a squeezed mid-market property today, you really can't hold your breath for policy change. You have to manufacture your own margin. Which brings us to the sharp end of revenue optimization.
Right, and right now the sharpest tool we have is also our biggest liability. The HFTP and MS Global Hospitality Business Competition just released some critical research on the ethics of AI-driven dynamic pricing.
This is such a hot topic.
It is. We all accept standard dynamic pricing based on supply and demand, right? If the city is at 90% occupancy, your rates go up.
Sure, that is fair market economics.
Exactly. But AI allows for something far more aggressive. Micro-segmentation, leading to what they call price walking.
Now, I've heard this debated endlessly, but airlines have been doing a version of this for years, right? And e-commerce platforms change prices based on your location all the time. Why is price walking suddenly viewed as this massive brand killer for hotels?
Because hospitality relies on a fundamentally different psychological contract than buying a generic seat on a plane.
Okay, that makes sense.
Price walking uses an algorithm to ingest an individual's personal data, so their browser history, their loyalty tier, their past dining spend, and it calculates the absolute maximum threshold that specific person is willing to pay.
Wow.
Then it raises the room rate just for them. It completely detaches the price from the market value of the room and attaches it to the guest's personal financial vulnerability.
Yikes. Yeah, the HFTP research highlights the inevitable fallout from this. Like, imagine if two guests are sitting at your lobby bar having a drink,
Right.
and they realize they booked the exact same room type at the exact same time, but one paid 35% more simply because the AI analyzed their browser history and flagged them as having higher discretionary income.
Your brand equity is dead.
Dead. That guest will never trust your direct booking channel again.
Never. It preaches the trust that the entire hospitality model is built on. And honestly, the European Commission is already mapping regulatory frameworks around this, utilizing data from the Cornell Center for Hospitality Research.
Just the regulators are already watching.
Closely. If our industry doesn't self-regulate how our revenue algorithms treat our guests, the government will mandate it, and the compliance costs will be staggering.
Yeah, so if you can't rely on an algorithm to squeeze extra margin out of your existing guests, your only real alternative is to massively expand your organic top-of-funnel demand.
Exactly.
And Accor has just launched a fascinating initiative aimed directly at the next generation of marketing. They've rolled out the All Accor Creator Academy.
Spearheaded by Adrian Williams here in the Pacific.
Yes.
From a pure strategic marketing perspective, this is genius. It's a free, mobile-first training program running 3 to 5 weeks, and it's designed entirely for travel influencers and content creators.
That's a great idea.
Yeah, and they culminate the program with a creation week at specific flagship properties. Places like the Hotel Woolstore 1888, Shadowplay Melbourne, and the Novotel Surfers Paradise.
Yeah, I mean, every GM and director of marketing knows the daily headache of opening their inbox to dozens of emails from self-proclaimed influencers, right? Demanding a free 3-night suite upgrade in exchange for a couple of low-resolution Instagram stories.
Right, it's usually an immediate delete.
Exactly. But what Accor is doing is taking control of the creator economy.
They really are. They are standardizing the quality. Instead of swatting away amateur pitches, Accor is bringing them in-house, training them on how to produce content that actually drives measurable conversion.
Treating them like actual marketing partners.
Yeah, and then awarding them an industry-recognized hospitality creator certification. They are proactively building their own army of highly vetted organic brand ambassadors who actually understand commercial marketing metrics.
It transforms a nuisance into a measurable sales force.
Perfectly said.
Which really brings all of this back to the core operational truth of our industry, doesn't it? Whether you are managing complex franchise relationships, navigating a K-shaped consumer market, or vetting digital creators, the success of your asset ultimately relies entirely on the talent executing the vision.
It always comes back to the people.
Always. So let's look at the leadership moves shaping the region this week.
We are seeing a lot of cross-border and cross-brand mobility right now. Starting in New Zealand, Michael Serino is taking the helm as general manager at the Hilton Auckland.
Nice. And in Victoria, Cassie Liddell steps up as hotel manager at the Doubletree by Hilton Melbourne Flinders Street.
Bianca De Para is stepping into a new challenge as assistant front office manager at the Branksome.
Excellent. Looking at the broader region, Subin Darman has been appointed general manager of the Mandarin Oriental Taipei, which is a critical market for luxury inbound.
Absolutely. Back in Queensland, Rob Unson is bringing his extensive experience to his new role as general manager at the Sofitel Brisbane Central.
And a really interesting move at the luxury tier. Cyril Warsono has taken the reins as manager of food and beverage at the Peninsula Hotels.
That's a big one.
Yeah, seeing top-tier F&B talent move like this reinforces how critical dining concepts have become to driving local foot traffic into luxury properties.
For sure. Accor is also strengthening its regional human resources, with O'Shea Lunn stepping into the role of Portfolio Director of People and Culture for CP Hotels New Zealand and Fiji.
Great move. Finally, Wissam Aboujad has started a dual role as General Manager and Corporate Operations Lead at Ascot. which signals a heavy focus on bridging property-level execution with corporate strategy.
A huge congratulations to all of you stepping into these critical roles.
Absolutely, congratulations.
It really takes exceptional tactical awareness to navigate the environment we've discussed today. We've covered a lot of ground, from the sheer capital intensity of building drone landing infrastructure to the unbundling of management with white label operators to the ethical landmines of AI pricing.
We really ran the gamut.
We did. But, it raises a foundational question for the future of our business. If the global brand controls the booking distribution,
Right.
and the independent white label operator controls the front desk,
Yeah.
and a third-party AI algorithm dictates the price, who actually owns the relationship with the guest?
That is the million-dollar question.
It's a question every owner and GM needs to be able to answer.
That wraps up this week's 5-Star Weekly Briefing. Thanks for tuning in and staying informed with the latest in the hotel industry.
Don't forget to check out our 5-Star Conversations podcast, where Brendan Granger from Technology for Hotels sits down with the industry's most influential leaders to uncover their journeys, insights, and the future of hospitality. It's a must-listen for anyone passionate about elevating their guest experience and driving innovation in the hotel world.
Until next time, stay well and stay ahead. See you next week.